Hi everyone, this is Andrew, Financial Risk Manager. Now, given the turbulence we have seen in the market in recent weeks, I thought it was prudent today to talk about what beta means, both in the broadest sense, what is the definition, how can you measure it, and what it means for you and your portfolio. Now, every stock's return can really be broken down into two components. There's the beta, which can be defined loosely as the portion of return attributable to the general movement in markets. And then there's the alpha, that is the specific return, the return you get for the specific risks of this individual stock or benchmark. Now, beta is generally measured based on the most common benchmark for the market that you're investing in. In the US stock market, the most common benchmark that people use when measuring the performance of their equity portfolios is the S&P 500. So for the remainder of this conversation today, I'll be talking in terms of S&P 500. That said, if your portfolio is heavily in US fixed income, that benchmark would be the Barclays Aggregate Bond Index. If it is predominantly in the UK, it might be the FTSE 100. If it is in German, it would be the DAX, etc. So the market index is seen to have a beta of 1. What does a beta of 1 mean? Well, beta is really trying to measure when the market moves, how much and what magnitude does your investment move with it. The beta is not directly related to something like covariance or correlation. Correlation would be to say, how often do two investments move in the same direction? An example of positive correlation would be, generally speaking, a company like Berkshire Hathaway, or to take possibly a more common example, would be GM or GE. They would have a beta you'd expect of somewhere around 1. They are moving heavily with the market. Whereas something like an investment in gold would have a beta closer to 0, because gold, while it can be very volatile in its own, tends to not move with the equity markets. So trying to get a low beta portfolio is very different than trying to get a low correlation portfolio. Low correlation portfolio means that your portfolio is going to kind of cancel out each other's movements, and they're not all moving in, everything you're investing in isn't moving in the same direction at the same time. A low beta means when the market is swinging wildly, your portfolio is not necessarily expected to swing in the same magnitude as the market. So when I say magnitude, what does that mean? Unlike something like correlation is measured on the measure of -1 to 1. Either you are totally correlated, you always move in the same direction, you are totally uncorrelated, or you're totally negatively correlated, you always move in complete opposite directions, or 0, you are uncorrelated, the movement in one has no bearing on the movement of another. The beta is really measured from, well, positive to minus infinity. Now, in practice, you're not going to get a beta of negative infinity, but a negative beta would mean for every $1 increase in the market performance, you would expect a $1 or some fraction of $1 loss in your portfolio, and vice versa. An example of something with a negative beta would be, say, the direction ETF bear shares. It is a levered market index that gives you exposure to inverse movement in the S&P 500. So you would expect the beta there to be negative, because you'd expect it to be roughly -1 to -3. I think they have 1x, 2x, and 3x shares. And that's based on how levered you are against movements against the S&P. On the other end of the spectrum, for vanilla ETFs like the VOO or the SPY that track the S&P 500, you would expect a beta of 1. Your portfolio, any individual investment you have, might have a beta of 0.5, beta of 2, beta of 5. What that means is if your beta is, let's say your beta is 2 on an individual stock, that means for every $1 movement or every 1% movement, we really should talk in percent return as opposed to in raw dollars. Every 1% movement in the S&P 500, you would expect a 2% movement in the beta 2 stock. Now, managing your beta and measuring your beta is important because in times like this where the S&P 500 moves pretty wildly, it kind of dictates the volatility that you would see in your portfolio, or it might inform your expected volatility. So the next question comes, how can I really measure beta? More often than not, if I'm considering the beta of an individual stock, I would go into a tool like Excel or into a tool like the Bloomberg terminal and do a regression analysis of the returns of the stock versus the returns of the S&P 500. Our regression analysis really takes those two return time series and plots them as a scatter plot against one another and sees, can I draw a straight line between that is approximately correct. The beta is the slope of that line, and that is, again, the relative magnitude of the shocks of your individual, the relative magnitude of the returns of your individual company versus the returns of the index. The next problem, though, is you're typically not really considering the beta of any individual stock in isolation. For the purpose of managing your portfolio, you really should be considering the beta of your aggregate portfolio. Now, you can do that in two ways. One, you may be concerned. I know in the hedge fund I currently work in, there is appetite among our institutional clients to know what the realized beta was. In practice, based on where your positions were over time, how exposed have you been to the market? The way you determine the realized beta is given you would need to account for things like investing additional dollars into your portfolio over time. You'd want to keep the baseline investment roughly equal. The best way you can kind of account for that is treating dollars put in later as cash effectively, which has a beta of 0 for this purpose. A dollar is always equal to a dollar. But then you kind of want to calculate the aggregate value of your position based on your position on each given day for a good beta regression, a good beta estimation really should be off of 2 years or so of data. And that data would be captured on a weekly basis. You really don't necessarily need a daily basis for this because that kind of gives a little too much data. It might introduce some noisiness into your regression, but a weekly return would be sufficient. But you want to calculate the market value based on your positions over time and then regress that against the S&P 500. That'll tell what beta you actually realized. Based on how you were positioned over time, how is your fluctuation versus the S&P been? Now, I think the more important thing for evaluating new investments or evaluating the riskiness of your current portfolio into the future, as opposed to trying to do, historical analysis, would be to get your theoretical beta. And the theoretical beta is taken by determining the value of your portfolio today and your positioning today. So if you are invested in 5 shares of Apple, 5 shares of Microsoft, 5 shares of Tesla today, assume that you've held that over the past 2 years and then determine the market value of that position over the last 2 years, sum it up, take a return series off of that, and then regress the return of today's portfolio as if you held it for the past 2 years going forward. That'll tell you kind of where you'd expect your portfolio to move into the future with, in this case, the S&P. This is good to know, mostly so you can kind of keep your expectations in check. For a person like myself, my portfolio currently is a beta of somewhere around 1.5. So for me to see market swings in the past week of roughly 15% on my portfolio has not been super shocking and has not led me necessarily to panic. Kind of managing expectations is really the name of the game here, especially in very volatile markets. And we're not talking yet about investing in that volatility. We're talking about investing in cash instruments, in pure equity and the like, things that will be readily available to you and things that will not put undue risk on your portfolio without you kind of understanding those risks. At a later date, I'll talk a little bit about what it means to invest in the options market, how to measure risk there, and how to hedge that risk. Right now, in the space that I'm talking about today, of determining your market beta, that's trying to put a figure on the riskiness of your portfolio relative to the market. When your portfolio is, like mine, long equities and bonds only. Because when you are in a long only space, you are not really able to hedge. All you're doing is managing the riskiness you have to the market. You aren't actively removing risks. Beta is also super useful because there are strategies in long short investments and when you're using options, futures, and the like, that you can do what is considered to be portable beta. That is, you can hedge out the risk that your stocks hold to individual markets, or possibly do interesting things like say, I want the specific risk of Apple as a company, but I want it held as if the market risk it was exposed to is Great Britain or Germany. There are some very cool things that you can do there, but very sophisticated. I could talk about that at a later date if anyone expresses interest. For today, I hope you learned something interesting. I hope you go back and attempt to perform this type of analysis, both correlation and beta analysis on your portfolio, so you can understand how well things in your portfolio move in tandem and in magnitude as we go through this kind of bumpy time in the markets and in the world. With that, invest safe, don't do anything drastic, have a lovely day, and I hope to see you back soon. Take care.